Ready to unlock the secrets of today's economy? You're in for a treat.
Absolutely. We're diving into perspectives from top analysts who break down complex topics for you.
With insights from heavyweights like Danielle DiMartino Booth and Jeff Snider, you'll walk away informed.
And the best part? We've distilled hours of analysis into concise summaries that you can digest in minutes.
Imagine grasping essential trends before they become mainstream. How valuable would that be for your investments?
Stay tuned. By the end of this video, you'll know how to navigate inflation and what's next for Bitcoin.
Just a quick reminder, this content is for educational purposes only and not investment advice.
Let's get started. First up, we hear from Danielle DiMartino Booth on the implications of Fed policies.
With the economy navigating uncertain waters, what insights can our listeners glean from today's discussion?
Danielle presents hard-hitting analyses on job losses and inflation management strategies heading into the new year.
Let's break down these complexities to reveal the potential impacts on ordinary investors.
With unemployment inching towards 4.3%, it's crucial for investors to rethink their strategies.
Does that mean we should be cautious or looking for bargains?
A little bit of both. It's about understanding the context of these shifts.
The revisions to payroll data indicate we might have been in recession for longer than we thought.
If layoffs are increasing, does that signal a worsening economy?
Yes, and every layoff isn't just a number. It represents a household impacted.
The Fed is primarily concerned with shelter inflation, which holds significant sway over CPI.
What does that mean for the average American?
It means that any drop in shelter inflation could provide a temporary reprieve from the overall inflationary pressures we've been feeling. We're seeing record high inventories in housing pushing prices down.
So, if there are more houses than buyers, does that mean it's a buyer's market?
Exactly. We're shifting from a seller's market to a more balanced environment.
If the new administration succeeds in cutting wasteful spending, it could lead to a stronger economy, albeit in the short term.
But that could also hurt consumers immediately, right?
Absolutely. It's a fine balance that requires careful consideration. As credit defaults rise, it's essential for consumers to assess their financial situation.
This isn't just about numbers, it's about real families facing dilemmas.
So what should our viewers focus on in their personal budgets?
Adjustments could be imminent in the consumer spending landscape as wallets tighten.
So it's crucial to strategize now rather than later.
Exactly. Preparing will allow viewers to navigate these changes effectively.
Investors should keep a close eye on housing prices, as they could shift substantially.
Are we advising buyers to wait for the market to cool?
Absolutely. Patience may lead to better opportunities.
It's about adjusting your strategies as the landscape changes.
Investors must remain aware that every economic shift has implications.
So continuous learning will be our best asset moving forward.
Join us next time as we delve deeper into adapting your strategies to a new economic environment.
We'll provide actionable steps you can take right now.
This is a journey worth undertaking.
The Swiss National Bank just shocked the markets again. They cut interest rates by 50 basis points instead of the expected 25. This sends a huge signal to policymakers worldwide.
Absolutely. This isn't just about Switzerland. It's emblematic of global economic tensions. The new chief, Martin Schlegel, didn't mince words when he hinted at possibly moving interest rates negative if necessary.
Negative rates? That sounds pretty drastic. What does it all mean for the average person?
Think of it like this. It's the Swiss response to deflation risks swirling around globally. A negative rate is like a financial lifeboat when the economy is sinking.
Switzerland is often a canary in the coal mine. Their early rate cuts are warning signs that many other central banks are ignoring.
So you mean to tell me the Swiss are trying to look out for everyone else?
Exactly. They saw trouble long before everyone else. It's like they're the early bird spotting the worm while the rest are still snoozing.
The SNB was the first major bank to cut rates back in March, sending shockwaves through the financial world.
But why did they choose to cut now? It feels counterintuitive with everyone else still focusing on inflation.
Isn't it like a chess game? They seem to anticipate the opponent's next move.
Their latest forecasts predict inflation will hit just 0.2% in the next quarter, deflationary territory.
So prices dropping could lead to people waiting to buy, pushing prices even further down.
Exactly. It's like waiting for a sale that never ends. Consumers hold off, thinking prices will drop even more.
OPEC just lowered its forecast for global oil demand for the 5th time. This is no coincidence.
So if oil demand is dropping, how does that tie back to Switzerland?
Think of it like dominoes. When one major economy wobbles, others inevitably follow, including Switzerland, impacting their monetary policies. As we look ahead, there's a solid chance we'll see more rate cuts, even pushing rates negative in some areas.
Sounds ominous. Are we looking at a recession risk for global economies?
It's like a game of Jenga. Removing too many blocks could bring the whole tower crashing down.
The takeaway? Remaining adaptable and ready to respond is crucial for financial health.
Watching the Swiss can provide valuable lessons for navigating future economic storms.
So, staying informed is key for anyone looking to safeguard their investments in these unpredictable times.
What can we expect with Bitcoin aiming for that elusive $100,000 target? Okay, let's dive deep into the world of Bitcoin and the ominous specter of deflation, shall we?
Where to begin? If Bitcoin can't hold the $100,000 barrier, we could witness turbulence across all risk assets.
So you're saying if Bitcoin falters, we should brace for impact, right?
Exactly. Think of it like a house of cards. One card out of place, and the whole structure could tumble.
Look, we're entering a storm of risk. If we see a correction in stock markets, Bitcoin will likely follow. The stakes are high.
So, a drop in stocks equals a drop in Bitcoin. That sounds like a dangerous correlation.
Indeed, it's like a synchronized dance. If one steps wrong, the others may follow suit.
Imagine a 10% drop in the stock market. That's basically $6 trillion evaporating. Now that's severe.
That's the type of reality check that can shift massive market sentiments.
Are we really that vulnerable? It sounds dire.
Bitcoin has been effective at summarizing investor sentiment. Once it stands firm or crumbles, the rest follow.
So it acts like a bellwether? That's intriguing.
Exactly, like the canary in the coal mine for the broader economy.
The ETF landscape is burgeoning, bringing in billions, but that also creates pressure at psychological barriers like $100,000.
So if I understand correctly, if a wave of profit-taking occurs, it might just trigger a downward spiral.
A bit like a game of Jenga, then, where one prudent move could destabilize the whole stack.
Jerome Powell has even suggested that Bitcoin and gold are competing assets. Isn't that fascinating?
It is. Historically, gold has been the go-to hedge, but Bitcoin is now playing that same game.
This feels like a rivalry for the ages.
As for my predictions, I foresee Bitcoin struggling against the headwinds of potential deflation, especially as market dynamics shift.
Right? It could feel like watching a seesaw. One side up means the other must come down.
That doesn't sound good for my crypto holdings. Even worse for the traditional assets.
The moral of the story? Stay alert. The economic climate is shifting, and Bitcoin's trajectory will influence various markets.
So really, whether you're for cryptocurrencies or traditional assets, adaptability is key.
Precisely. It's about riding the tide, stay informed, and be ready to pivot. As we enter what many call a recovery, Stephanie Pomboy dives deep into the economy's true pulse.
The euphoria surrounding low unemployment numbers is fascinating, but wait until I share what the household survey reveals.
Are we really having a recovery, or is it more of a mirage in the desert of economic data?
It's alarming, really, how the payroll survey shows a different story compared to what's happening in households.
So you're saying the job market might be more precarious than Wall Street thinks?
An implosion seems inevitable, given the current divergence and investor sentiment.
We're witnessing a 3 million job discrepancy, one that we haven't seen outside of COVID.
How can these numbers be so opposite?
It's like seeing a bright sunny day while everything inside is falling apart. What gives?
Even if a recovery is on the horizon, current valuations have reached staggering levels.
People are betting on optimism, essentially pulling future profits into today's prices.
So are we just hanging by a thread, waiting for the first gust of wind?
If history is any teacher, the Fed usually reacts post-damage. What will unfold next?
And if there's pressure on prices, can the Fed maintain their current strategies without chaos?
It's like a high-wire act without a safety net. Someone is bound to fall.
The smartest thing you could do is seek companies with solid balance sheets.
And speaking of safe havens, let's not dismiss gold in uncertain times.
So focus on safety first? Sounds like a plan to me.
Long-term, markets might find solace in the hard assets as growth remains shaky.
But will investors then have the courage to pivot towards emerging markets?
It's like standing at a crossroads. One option is unsettling, the other offers hope.
The stock market might head toward a dramatic downfall, a stark contrast to current euphoria.
Is it possible that the optimism is just a bubble waiting to burst?
I can already feel the tension rising. When's the other shoe going to drop?
Don't succumb to FOMO. The risks are tangible, whether you're on Wall Street or Main Street.
Exactly. It's all about being prepared and not getting caught in the chaos.
So the key is to keep a level head and stay true to your investment instincts.
Next, we analyze the looming effects of rising interest rates on housing and homebuyers.
How do we navigate through the ongoing shifts in the housing market?
You won't want to miss it. The implications concern us all.
Today, we're dissecting the monumental question: can the U.S. economy do the impossible?
Euphoria seems to be the flavor of the day, especially after Trump rang the bell on Wall Street, cheers of USA echoing. But what lies beneath this surface?
How does this all stack up globally when many countries are struggling?
The optimism on Wall Street is stark, but is that optimism reflected in the household balance sheets?
Exactly. A rising tide lifts all boats, but can the U.S. tide actually raise the global fleet?
When we look at China and Canada, the numbers are startling.
There's an undeniable sense of euphoria in the air. Stock prices are high, while there's latent economic distress elsewhere.
Yet, with a significant number of people questioning their financial well-being, should we really party?
Is this market's response just a bubble waiting to burst?
Canada's unemployment spiking means fewer consumers. They can't prop up demand.
But if the US is still doing well, isn't there hope?
Hope doesn't always translate to numbers, especially when economic ties are so closely knit. It's perplexing. Why is the Fed cutting rates with CPI rising?
Isn't that like having a leaky faucet and raising water pressure?
Right, and the rationale seems to be hidden in smoke and mirrors. Should a recession take hold in major markets like China, could that trigger a US slowdown?
Without a doubt, it's all interconnected, like a game of Jenga. One pull, and it all collapses.
So should I be ready for the economic domino effect?
Imagine a future where the U.S. holds its ground amidst global turbulence.
Or on the flip side, we could see a parallel to 2008, painful and unavoidable.
Is there a roadmap to shield ourselves from this?
What if we see stagnant growth as the world recovers?
Then individual investors must prepare for a different kind of battle.
A battle of wits against ever-evolving economic landscapes.
That's the kicker. A slow domestic market could change everything.
And that might put a damper on all those jubilant stock trends we see.
So staying informed is critical.
Ultimately, we must keep our eyes peeled. Global dynamics matter.
It's no longer just about our borders.
So I'm ready to dig deeper into the data?
What a fantastic array of insights we've had today.
Definitely. George, Stephanie, Mike, Martin, and Danielle provided us with a rich tapestry of ideas.
It's striking how they all acknowledge the urgent need to rethink monetary policies.
Exactly, and the rising unemployment issue is a looming shadow over growth prospects.
Yet, we see such different takes on the stock market. Stephanie's worried about a crash, while others are more optimistic.
And don't forget the cryptocurrency debate. Mike's prediction for Bitcoin is bold, but it raises eyebrows.
There's clearly a lot to unpack here. It's like a financial chess game.
Absolutely. Staying informed is crucial in such a dynamic environment.
If you enjoyed this discussion and gained valuable insights, please give us a thumbs up.
And don't forget to subscribe. Your support helps us bring you more great content.
Thanks for tuning in. Be sure to check out our other videos for more financial wisdom.